Hello.
In fact, some businesses enter into millions of transactions each day. Think about McDonald's. How many transactions are taking place in the stores owned by that company, on each and every day? Now, these transactions are not that big, Somebody comes in and, buys a lunch or dinner and pays $3. That transaction is fairly small and insignificant. But if you take that transaction and multiply it 1,000,000 times, the numbers start to get significant. If we are going to ultimately present a balance sheet to investors and creditors that show the true financial position of a business, we must capture each and every one of those small and separate transactions and identify and analyze and record the effect of that transaction on the financial position. We're going to do this through the accounting system of a business. A company's accounting system is the means whereby all of a company's transactions and their effect on the company's financial position, each one of these millions of transactions, are identified, recorded, and then summarized in a way as to how it affected the financial position, so as to periodically produce the general purpose financial statements that are required for investors and creditors under generally accepted accounting principles. The first 3 steps in an accounting system are first to identify each and every business transaction. Then number 2, to analyze each of those transactions to determine its effect on the financial position of the business. And then somehow, somewhere, we must record that transaction. Record the transactions and their effect on the financial position. Now, in a computerized system, this might be done in the memory of a computer. Or in a manual system, it might be done in some document way, some hard copy record. In understanding the process of recording transactions, I need to first introduce to you some new language and terminology that we're going to be using in this process. First, let's talk a little bit about cash. When we enter in transactions, think about McDonald's, probably the most common element of financial position that's affected by the millions of transactions is cash. Most of their sales, they receive cash. And so every time McDonald's has a sale where they receive cash, they must identify that, record it, and then summarize that information so that they know how much cash they have at any point in time, and especially at the end of the year, because that amount needs to appear on the balance sheet as one of their assets. In order to kind of organize ourselves relative to how much cash we have coming in or going out and how much we have at the end of any particular period, one way we could possibly do it is to draw a big T. Now, I'm going to just do it here on a piece of paper, but we might do it in some computerized system in the memory of a computer, but I'm going to do it here just to kind of organize ourselves relative to accounting for cash. Now, as far as cash is concerned, there's only 2 possible things that can happen. In a transaction, cash is either coming in or it's going out. And those are the only 2 possibilities relative to cash. If I'll draw this big T account and say, okay, let's organize ourselves and put on the left side of this, every time we have an increase in cash, we will record that increase on the left side. We're simply going to distinguish increases from decreases to kind of organize ourselves. In this case, we'll say we entered into a transaction and we had cash coming in from that transaction of $300. We'll put that simply here on the left-hand side to keep track of it. And all increases in cash we'll put on the left-hand side. If, in fact, that's what we're going to do, increases on the left, we'll make the right-hand side the side where we record any outflows or decreases in cash. And if, in fact, we pay out cash of $200, we'll show it on the right-hand side, along with all the other payments or outflows of cash. If at any point in time we want to organize ourselves and really determine if we have a balance of cash, we'll simply add all of the entries or transactions that have been entered on the left-hand side, which were increases, deduct the decreases, record on the right-hand side, and come up with some kind of a balance, maybe a running balance, in this case, $100. Now, you're not going to like what I'm going to tell you next. When we're talking about increases and decreases in cash, I'm going to use some language that's probably going to be a little unfamiliar, at least in this context. We're going to call the left-hand side of this organization that we've set up here, this T account, the left-hand side, the debit side. I'm going to actually give that an initial. We're going to initialize it as DR. That comes from a root Latin word for debit. Debit simply means left. However, relative to cash, not only does debit mean the left side, but because we've designated the left side as increases in cash, debit to cash also means an increase to cash. The right-hand side is going to be referred to in our accounting terminology here as the credit side, CR abbreviation. The credit side means simply the right side. However, relative to cash, not only does it mean the right side, but because the right side is used to designate decreases in cash, a credit to cash is also a decrease in cash. All right. For every single transaction that a business enters into, we have previously stated that assets must always equal liabilities plus owner's equity. But for every transaction, not only must we have assets equal liabilities plus owner's equity, but we're going to set up a second required formula. That is, that for every transaction, the entries on the left or debit side of an account must be equal to the entries on the right or credit side of an account. Okay, if the asset that is being received is cash, and we're going to account for this now in an organized way to keep track of all the inflows and outflows, we might set up a T account for cash, and for this particular transaction, we will show an increase on the left or debit side of cash. Now, in this particular case, in analyzing the transaction, there were no liabilities incurred. Stephen, the business, received this cash but has no obligations to return it. In fact, what we have is a contribution of capital by the owners, which is reflected as owner's equity, or simply a manifestation of the amount of assets that have been provided by the owners. And we're going to refer to it as contributed capital or as capital stock in most corporations. We'll assume that Stephen's Sweet Shop is actually a corporation issuing stock, and therefore it issues stock to Stephen in this particular case. If, in fact, we set up a T account to keep track of any increases or decreases in the amount of capital stock that has been issued to owners, representing the amount of capital contributions by those owners, then we must designate one side to keep track of all of the increases and one side to keep track of all of the decreases. Well, what side are we going to pick for capital stock? Well, if we've established a rule that for every transaction, the total amount of debits or entries to the left side of accounts must equal the total entries or to the right-hand side or credit side of an account, then what will we do then to capital stock? And the answer is we're going to show it on the right-hand side or the credit side. That is what we're going to do not only for capital stock but for all owner's equity accounts. Increases in capital stock are going to be shown on the right-hand side, and decreases in capital stock outflows will be on the left-hand side. Now, this is exactly the opposite of cash. But we're going to make this rule for not only capital stock, but all owner's equity accounts. Increases will be on the right or credit side and decreases on the left. Now, let's look at another transaction. In fact, the second transaction that Stephen entered into was that he actually got another $200 of cash from me. and he borrowed it from me, saying that he would repay it in the near future. In this particular case, we analyzed this transaction and said that, in fact, there was an increase in the business's assets. Cash came into the business. We'll show that on the left-hand side, or the debit side, because we've made that rule. For cash and all assets, increases are going to be on the left-hand side every time, which is the debit side. In this particular case, an obligation or liability has been established, and we're going to reflect this as notes payable, a liability. This is an increase in notes payable. But should an increase in notes payable be on the right or left-hand side of this T account designed to organize the increases and decreases so that we can then create an ending balance at any point in time? And the answer is, well, if debits are going to equal credits with any transaction, that increase must be on the right-hand side. This is the rule. For liabilities, increases will always be on the right-hand side or credit side of an account, and decreases on the left-hand side. What I'm really saying is on the left-hand side of our basic accounting equation, assets will always be increased on the left or debit side and decreased on the right or credit side. But on the right-hand side of our basic accounting equation, it will be exactly the opposite. All liabilities and owner's equity accounts will be increased on the right-hand side and decreased on the left. Okay, well now, how do you remember the effects of debits and credits on these various kinds of accounts in an accounting system? Assets are increased on the left or with debits, decreased on the right with credits. Liabilities are exactly the opposite, increased on the right or credit side. The same with owner's equity. Within owner's equity, we've talked about different kinds of accounts. For example, capital stock. Capital stock is an element of owner's equity. Increases in capital stock increase owner's equity, so increases in capital stock will also be increased on the right-hand or credit side. The same with retained earnings. The higher our earnings retained in the business, the higher our owner's equity. Therefore, retained earnings is increased on the right-hand side, or with a credit. Revenues. The higher our revenues, the higher our net income or profit. And therefore, increasing revenues increase profit and therefore retained earnings, and therefore owner's equity. So increasing revenues will also be on the credit or right-hand side. Where it gets a little confusing is with respect to expenses and dividends. Increasing expenses have what kind of an effect on net income or profits? If we have more expenses, more costs of doing business, more rent, more salaries, what effect does that have on our profitability? Well, higher expenses means lower net income and therefore lower retained earnings and therefore lower owner's equity. Increasing expenses have a negative effect on owner's equity. Therefore, expenses will be increased on the left side because the left side of owner's equity is a decrease in owner's equity, and increasing expenses have a negative or decreasing effect on owner's equity. The same is true of dividends. If we distribute more of our net income in the form of dividends to our owners, what is the effect on retained earnings? You'll recall that dividends distributed by the company, the owners, reduce retained earnings. Well, a reduction of retained earnings is on the left or debit side. If increased dividends reduce retained earnings, increased dividends are going to have to be reflected on the left or debit side to cause that effect of a decrease in retained earnings. So, here's the bottom line. Assets, expenses, and dividends are increased on the left with debits. Liabilities, owner's equity, and within owner's equity, capital stock, retained earnings, revenues are all exactly the opposite, increased on the right, or credit side. You're just going to have to kind of memorize that. Now, there is some additional rationale to this. I call this the equation approach, and maybe this will help you kind of remember this. If you look at the basic accounting equation and in fact look at the expanded accounting equation, where we distinguish that owner's equity is actually made up of capital stock or contributions by owners to the business, or earnings retained in the business. And we expand that retained earnings to show that retained earnings is the result of net income less dividends. And we've also defined net income as the amount of our revenues minus expenses. Again, this is a review of lesson 2. In this particular case, if you look at the equation, all of the elements of the equation are positive elements, except for dividends and expenses. If you were to just apply algebraic principles here and manipulate this equation such that all of the elements, even dividends and expenses, were positive in the equation, what you'd do is you'd take minus dividends and you'd add dividends to both sides of the equation. That would eliminate dividends from the right side of the equation and place it on the left side of the equation. Same is true of expenses. If you were to algebraically get rid of the negative element or expression here of expenses, you'd add expenses to both sides of the equation, eliminating it on the right side and placing it on the left. Ultimately, we would have on the left, if everything was converted to a positive expression or element, we would have on the left side of the equation assets, expenses, and dividends. And the right-hand side would still be liabilities, capital stock, retained earnings, and revenues, all positive elements. You can see that if we make the equation all positive, then those elements on the left-hand side of the equation are always increased on the left. And those elements on the right-hand side of the equation are always increased on the right. Maybe that'll help you remember that.